What I've often said with chaotic capital structures is that if you can take the problems and extend them over a long enough period of time, hopefully 6 to 9 months, you can pretty much solve any problem. And what's happened with the direct intervention by the Fed and our government as well with all the stimulus is that a lot of the problems that are being experienced right now are being pulled over a longer period of time. And so that allows people like us that have an ability to bring solutions into capital structures to be incredibly busy. And that's why we've had so many co-investments since the start of the crisis. In terms of the market today for credit, I would say I'd bucket it in three different ways. I'd say US investment grade is completely not interesting. Apologies if you have a huge portfolio there, but it's essentially a Fed trade at this point. There's just not a lot of pain in the underlying companies that will be expressed in credit. There's definitely an equity story related to IG credit, but not a credit story in my view. And I would say the same is probably true for everything in the double B space in my world. It's all sort of wrapped into a giant Fed analysis. Once you get out of that zone, though, that's where it becomes much more interesting. I think it's also interesting that the Fed owned these waste management bonds and they got run over like everybody else in the trade as recently as last week, is that our part of the markets, this single B and worse, is really Adult Swim. And it will be allowed to find its own path forward. A lot of bankruptcies will happen. A lot of expensive solutions will happen that will ultimately lead to bankruptcies. And then I think there's a portion of the triple C market that will find a way to live post-COVID and survive and maybe even thrive. But I think that's the part of the market that is the most interesting and where I think there's the most opportunity for differentiated experiences for investors. And I think it's also the most interesting when you're in the smaller capital structures. I think the larger capital structures tend to be overanalyzed and overcapitalized. But once you get sort of sub 4 billion and even sub a billion, to be honest, that's a part of the market that I think there is less attention. And that's the space that we've been most focused on. The people that are in bankruptcy really have fundamental problems that were developing even before the financial crisis that we're in today or the pandemic. Companies that I think are overpaying for a duration bridge. We've seen it in the cruise lines. I mean, we saw Carnival yesterday paying 10.5% for high yield bonds. Norwegian today, a lot of the airlines, those I think are bridges to nowhere, to be honest. And I think on this, those are delays of a default. And those are capital structures where I don't think water is going to find a level without a more drastic reallocation of resources away from debt into equity and a new equity. Companies where I think the duration bridge is actually a good solution, where if they can just get 9 months, 12 months of time, they can either variabilize their cost structure in order to live in a different revenue environment, or they can get through to the other side where maybe there's a recovery post-COVID. So I think in terms of where we're spending time, the toolkit really depends. So the first bucket, which is the companies that are in bankruptcy, a lot of it's in the energy space. They're very poorly designed companies. They're destroyers of capital. Some of the infrastructure-based TMT companies, we have been involved in the bankruptcies there, but I think we've only been in the more boring parts of the structure because I think fundamentally those are businesses that really don't have a lot of terminal value. And then the last two buckets, which are really in and around the duration trades, that's where I've spent most of my time. All the bespoke financings we've done have been duration trades. And we've been only focusing on companies that we feel like if the COVID crisis lasts indefinitely and we have a new abnormal, that they'll be able to survive and thrive on the other side. And I'm avoiding the companies where I just think duration to a post-COVID world isn't one that's interesting. So that's the airlines and the cruises. So I think there's a very rich spectrum of stuff that's happening. And I think a lot of the duration stories that are being played out now are going to be bankruptcies in the next 12 months. And so we'll be playing on them in bankruptcy probably in a year from now, but for now they're not interesting. So it's sort of like there's waves of stuff to do that are all kind of slightly different. The single most important gift is to understand the cost structure of a company. Because most companies, especially asset-heavy companies where we tend to focus, have high fixed cost structures. And the worst part about a high fixed cost structure is that when your revenues are moving in a way that even if they're down single digits, the destructive impact on cash flows are noticeable. So companies that could have afforded their capital structures, and remember, a capital structure is the ultimate fixed cost structure, right? The only way to variabilize your cost structure is bankruptcy. the first thing I'm looking at with my analysts is how able are these companies to, where are they today? How much of their cost structure is fixed? And the other element is every fixed cost structure over time can be variabilized. How long does it take for them to variabilize it? So what we've seen so far is the single biggest fixed cost in most capital structures is people, which is why there's such pain that's happening right now, because that's been the part of the capital structure that's been variabilized, which is that people have just lost their jobs, millions and millions of people. And so the other question is, now we're seeing people not pay rent on their leases, taxes are coming down, and also the cost of input costs, for the most part commodities, although there's obviously some shifts happening in commodity space too. So that's really where we're starting. And then the second question is, how quickly can they variabilize some of those costs? The third question is, to the extent that you do have some recovery on the revenue side, how able are they to keep this reset cost structure in place so that they can actually grow margins on the way out of any problems? So again, so they can continue to service their debt and they can actually have a justification. Then the other question, so that's where I start. The second question is the revenue line, which is, do these companies really even have a business anymore? In a post-abnormal, or the new abnormal, I guess is what people are calling it, or post-COVID. And there's some really tense conversations around that. The airlines are obvious. You're seeing what's happening with American and United now announcing that they're essentially laying off tens and thousands of people. The cruises I've also mentioned. But any business model that involves people being together in a closed space for extended periods of time with poor air circulation, one has to question whether the revenue story of this company exists in a post-COVID world. And even after some sort of solution comes in, how quickly it comes in, and whether these companies really have a place in our markets that justifies debt. So some of these COVID heavy names are probably perfectly reasonable equity investments. But to buy a bond or a loan in them, it's tough, in my view, to do, because one doesn't know where the bottom is. And I never want to have an investment where I think that there's a real risk of principal destruction. I think we've seen absolutely the lows in IG. I think we've seen the lows in the double Bs. The idiosyncratic nature of the triple Cs is that it's not really just a question of how the instruments trade, it's a question of how they refinance themselves. And one thing that we've seen in this sector, one of the reasons that so much of my focus has been on the primary market, is that the cost to finance a new deal is materially higher, more expensive than where the secondary instruments trade. So it does tell me that the markets are telling me that capital is precious. And when capital is precious, that's when we get a return. But what you're seeing in IG is there's no new issue discount anymore, right? You're basically buying new bonds at the price where the existing stuff's trading, because people just want to put capital to work quickly. You know, they feel like they're saving themselves the bid-ask spread, and that's why they show up for the new deal. Which, to me, most of these high yield capital structures, they're sort of a lockbox, or sort of a closed loop, in the sense that everybody in the structure is in the structure. But to be able to get another dollar into the capital structure, you've got to incentivize a new person to show up. That incentive comes in the form of rate, comes in the form of documents, and it comes in the form of solutions being precious, because companies don't necessarily know how to deal with these issues. A lot of what's happening too is the loan market is returning to where its rightful places in the levered finance market, which is much smaller than it has been over the last 5 years.